What's up, guys? It's Cash Flow Cart. Today we are talking about a stock I've spoken on a lot about, but real briefly, let's get into a quick life update. So, it's been a busy week for me. I've worked a lot. I voted, so that was exciting to vote. It was the first time I voted in a presidential election, so kind of a cool experience. Apart from that, pretty much been working every day, trying to stay in the gym when I can, hanging out with some friends. I've been busy, bottom line. Today is my first off day in, I don't know, 6 or 7 days probably. So I'm kind of just trying to take care of myself today, get some stuff done around here. I gonna get the room cleaned up a little bit. I bought some plants. I bought some trees at a greenhouse. I'm gonna get them put in better pots. Just random stuff. I kind of like on my off days just really doing random stuff that I've wanted to do, and I like to film videos. I do want to mention, guys, since Tuesday, I have invested roughly $1,500 into the dividend growth portfolio. So it's definitely been an eventful week. It's been an eventful week in the stock market, and we are going to get into it. The $1,500 I've invested has gone towards 12 shares of Hershey, ticker HSY, and then the remainder, or wait, 12 shares of Hershey. That can't be right. 7. 7 shares of Hershey. That makes a little more sense. And then the remainder went into Pfizer to boost that position a little bit. Guys, we are going to talk about Hershey today. It's been an interesting week with them. They had earnings come out today, November 7th, before market open, and we will get into kind of what story this earnings told. Okay, so I do want to preface this by visiting a quick summary of an article that came out on November 4th at 2024. For those of you who haven't kind of been following along with this Hershey journey I've been on, I think this summary, it'll catch us all up to speed. Okay, so we've talked about it a lot. Hershey stock has been trading sideways due to high cocoa prices and investor concerns over the impact of price increases on sales. So what we've talked about mainly with Hershey stock is it started kind of a downturn. Okay, this happened around the time when Ozempic first kind of came out, and there was a lot of concerns about consumer eating habits and what they would be buying at grocery stores, because Ozempic brought on kind of a whole, phase of people losing weight and changing consumer spending patterns slightly. This hit stocks like Hershey, Coca-Cola. It even hit stuff like Walmart. Okay, it was pretty widespread. However, it affected more the price action than it did actual underlying fundamentals. Okay, so I do think kind of the whole Ozempic thing started the Hershey downfall a bit, but I do also think it was a bit of an overreaction. Okay, Hershey's downfall continued, once we saw a global shortage of cocoa. Okay, obviously Hershey's main input, being a chocolate company, is going to be cocoa. And we've seen a lot of issues on East African farms and other places they grow cocoa. There's been diseases, there's been, unfavorable weather, and it's really affected their harvest. Okay, so there's two things. And then the last thing was inflation. We saw a good amount of inflation, especially hitting like this type of thing, individual products. Hershey did have to raise prices to kind of protect their margin on some of their chocolate. Okay, so there's three things that have led to Hershey falling and then trading sideways. Okay, so it hasn't necessarily been, you know, it hasn't been the most fun time in history to be a shareholder of Hershey stock. Okay, moving on. Again, this came out on November 4th, before earnings. Despite short-term challenges, Hershey boasts high margins, strong free cash flow. Guys, I talk about free cash flow in all my videos. I literally name the channel Cash Flow Card. And a growing dividend, making it a solid long-term investment. Okay, so we talk about this. A growing dividend, where does that come from? It comes from this strong free cash flow. If Hershey can continue to remain, in a place where they're generating lots of free cash flow year after year, they have been able to increase their dividend at a pretty impressive rate. Okay, that's one of the things that makes it attractive to me. Another thing is high margins. Hershey boasts high margins. We will look at their profit margin a little later, but what this says to me, essentially, if a company has high margins, they have more room to face headwinds like this, like we've seen Hershey faced, and still find profitability. Okay, so regardless of all these challenges, regardless of how, I guess, ugly the chart looks, Hershey's a profitable company. One other positive that I really want to focus on that isn't mentioned in this bullet point is Hershey's wide moat rating. Okay, essentially, if a company earns a wide moat rating, it has been determined that it will be able to generate growing free cash flow for 20 plus years into the future. Okay, after that 20-year mark, it's really kind of hard to estimate what's going to happen with the world. But Hershey is a company that has earned that wide moat rating, and those are typically companies I like. Okay, I'd give it to Hershey, Apple, Coke, any company that has such a strong household name and brand recognition, earns kind of that wide moat rating, and essentially Hershey has achieved that and has had that achieved for quite some time now. Another thing I talk about on this channel is going to be that wide moat rating. Okay, so moving on, Q3 earnings are expected to show the positive effects of price increases with potential EPS beat that could restore investor confidence. Okay, so what happened today? Earnings come out, and their estimate is just under $2.50 per share. They come in at $2.34 per share. So it's an EPS miss. Okay, and it has led Hershey to be down today, over 2%. Okay, and with that being said, I did, go ahead and put on 2 shares right before market close. I kind of wanted to see how far Hershey would fall today, and then I put on those 2 shares. Okay. Lastly, trading below market average with a 19 forward PE and offering a 3% dividend yield, Hershey presents a margin of safety and upside potential. Okay, I agree with this. I do agree there's a margin of safety, and I do believe there's a lot of upside potential. I also have spoken on anytime I've seen this one, above that 3% dividend yield, I've been able to lock in over 3% on a starting yield. It's been very attractive to me. I've been buying. Okay, you guys know I'm not a big PE advocate. We will visit kind of the the metric I like to use for valuation purposes. Okay, guys? So we just visited Hershey's PE, roughly 19 right now. Okay, does that make sense? Well, hang on. On a forward basis, just under 19. Okay, compared to their 5-year average, just under 25. Focusing on just that metric, it does show signs that Hershey could be, up to 25% undervalued. Okay, do you guys see how I kind of use these numbers? I use a current number, and I compare it back to its own 5-year average. The reason why I like to do that rather than using the sector median is the sector median is going to include a lot of other companies that don't have the track record that Hershey has, that don't have the wide moat rating. Okay, different companies are going to trade at, I guess, different premiums. Okay, a company like Hershey has probably earned the right to trade at a little higher premium than other companies within the same sector. Does that make sense? And for that reason, I think it's much more productive to compare, the company you're looking into back to kind of its own numbers. Okay, obviously that works better in a space like this, dividend growth or value investing, and it's not really going to make sense in some like speculative or super high growth sectors. It's just not as applicable. But for the type of investing I do, I compare, current data back to a 5-year average. With all that being said, I prefer to use price to free cash flow rather than price to earnings. Guys, the reason I do that is having this dividend growth bias. That's the type of investor I am. I only buy and hold dividend growth stocks. And it makes more sense to kind of have, free cash flow in the picture, because that number is going to be what the dividend is paid out of. Okay, so we compare Hershey's current price to free cash flow on a forward basis of 14.10. We're comparing it back to that 5-year average of 23.71. Using these numbers, it looks even more undervalued than it did with PE. So, this tells a story of roughly a 40% discount on Hershey right now compared to how it's been trading in the past 5 years. Okay, that's exciting to me. I see this as a good buying opportunity, but I do want to talk about profitability now. Like I said, just to mention again, profitability, bottom line, profit margin is so important to me because, I am holding these stocks for a long time. Okay, there's going to be different news, there's going to be different, world events, and the better profit margin a company has, to me, the better they'll be suited to handle, whatever the world throws at them. So we look at something like Hershey, where we're just looking at the chart and, we might think they've really been struggling lately. It's still a very profitable company. And we will visit the net income margin, guys. Their 5-year average is just over 16%. Okay. Their current is just under 17%. So with all this going on, with all these headwinds we've mentioned, Hershey is more profitable today than it has been, on that 5-year average trailing period. Okay, does that make sense? I really like to see that. Okay, I mean, these are fundamental metrics. This is not news. This is not speculation. This is not looking at a chart. This is real quantitative data that can tell me some type of story as an investor. Okay. One other thing I do want to mention is kind of, I guess, the takeaway from this video. As much as this has kind of viewed as a Hershey bull case, as a Hershey buying opportunity, I do think there is something else here, and I really want to make sure I get that point across. And I guess my point is, any great opportunity, any positions that really, speed up the compounding process, that where you get capital returns as well as dividend growth, any great plays, there's probably going to be some level of discomfort when you're building out these positions. Okay. Kind of the slow moving guys that are just kind of like, I guess, the more obvious, buy whenever, the stocks people say they'll buy whenever. It's not going to have, the same level as discomfort as something like Hershey right now when there is, news surrounding it. The chart does not look pretty, okay? But I do want to say, if you don't have the risk tolerance to kind of take on some of these names, you're not going to be able to compound your wealth as quickly. I'm not going to sit here and say I haven't made mistakes on risky plays. I have, guys. We will review them on the channel. We have reviewed mistakes I've made in the past on the channel. But my point is, in order to really get to that outperformance that we all, seek, there's going to be times with a little discomfort. And that's why it's so important to be real with yourself, to try and learn your own personal risk tolerance, and to kind of take, every investment, whether good or bad in hindsight, to kind of take that as a lesson to you guys. And that's kind of what I'm trying to do here with Hershey in the real time. I will keep you guys updated on the channel. Last thing we will visit, guys, I mentioned since Tuesday, I have invested, roughly the $1,500. Like I said, that went towards seven Hershey shares, and then how many shares of Pfizer? Hang on. So it was $1,500. I got 7 shares of Hershey at an average price of $177. I bought, 5 yesterday, 2 today. And then Pfizer, I guess 6. So 7 shares of Hershey, 6 shares of Pfizer. The Pfizer average price was $27 and change. And, with that $1,500 this week, I took this screenshot on Tuesday morning, I guess. The portfolio income was at $2,694 and change. Okay, now we were at $2,700 and, roughly $41. So, roughly increased the estimated income by $45 this week. I am happy with the portfolio. We will briefly look at, the allocation. I'm not going to do like some full review because I have whole videos dedicated to that. But real briefly, guys, this is my dividend growth portfolio. The largest position being Altria at, $13.5 grand, pays me just over $1K annually. Next up, we have Realty Income at just over $12K, pays me $700 annually. Next up, we have Apple at $11.5, pays me $50 annually. We have broken that $10K mark on Hershey, with these recent purchases, pays me $320 annually. Then Starbucks, $6,700 in market value, pays me $171. Next up, Microsoft, $6,400, paying me $50 in income. We've taken Pfizer now to 231 shares. That's at $6,334 in market value, paying $388 annually. And then last but not least, we've seen some bullish momentum on T-Row lately. It's been kind of a grinder at $1,600, paying me $65 in estimated annual income. Guys, thank you for tuning in to today's video. I'm Cashflow Cart. I post about my own dividend growth investing journey on Monday at 6 p.m. And if you want to be a part of this community, please subscribe. I appreciate you guys as always. Let's build wealth.